Hi, everybody. Welcome to Truth in Accounting's Ask the Experts webinar. We're going to thank the Union League Club of Chicago today, too, for co-sponsoring today's event. Today's topic is America's Unsustainable Fiscal Path. My name is Bill Bergman. I'm the Director of Research for Truth in Accounting. We're a nonprofit dedicated to helping citizens understand government finance with a view to promoting truthful government financial reporting. You can learn more about us at our website, where you can also sign up for our morning call newsletter, which compiles government financial news every day. We also offer our Data Z website, where you can create charts and research states, cities, and the federal government on a wide range of financial, demographic, and economic factors. Today's event is inspired by Truth in Accounting's new Financial State of the Union report. This report is based on the fiscal year 2020 financial report of the United States government, which came out in late March to a deafening silence. Mainstream media coverage of the report was basically zilch, including the major daily newspapers. A review of Treasury Department news releases about the report. If you look over those news releases in the days before and after the report came out, you see releases about Treasury officials meeting with African leaders about the COVID/climate emergency. You see statements by Janet Yellen on the International Trans Day of Visibility and a statement on bridge financing in the Sudan. But you don't see anything about the Treasury Department's release of the annual financial report of the federal government in the United States. We believe analyzing this report is important, and that's why we're here today and sharing some insights with you. We're honored today to have Chuck Chokel as one of our experts. Chuck worked in the insurance industry for more than 30 years, a very interesting perspective to think about the United States government. Chuck spent much of his career at Progressive Corp, rounding out his tenure there as Co-CEO, Chief Investment and Capital Officer, while serving on the board of directors. Additionally, Chuck has served on the board of directors of Esurance and Plymouth Rock Holding Company. Mr. Chokel received his BA from Williams College in Massachusetts and an MBA from the University of Chicago, where we shared some professors of distinction. He has completed over 250 triathlons, including 36 half Ironman distant events and 11 full Ironman distant events. Joining me and Chuck today is Truth in Accounting's founder and CEO, Sheila Weinberg. Sheila is a CPA, and she's led Truth in Accounting's initiatives since 2002. Her commentary on the federal government and its budget, Social Security, Medicare, and other national issues has appeared repeatedly in numerous publications, including USA Today, the Washington Post, and the Wall Street Journal. For today's event, everyone's going to have a chance to ask questions, and we hope you get a lot of them via the Q&A feature. Look at the bottom down at the bottom of your Zoom menu, and if you look down, you see the Q&A panel. Just type your question in that box anytime during the event, and we'll try to get to it. So now I'm going to turn it over to Sheila and Chuck for some comments, and then we'll get to the questions. Sheila?
Thank you so much, Bill. When I started looking at the federal government's financial conditions, I was worried about their deficits. Those were the good old days. Though we were only running deficits, I hate to say only, but we're only running deficits of $200 billion. Now those look like great numbers. Last year the reported deficit was $3 trillion. But we found that, and there was 1 month where the publicly held debt increased by $1 trillion in 1 month. We've just gone to la la land on creating debt. But as we calculated our financial state of the union, we determined that the government's debt didn't go up by just $3 trillion. If you add the increases in unfunded Social Security and Medicare, the debt actually increased by $10 trillion last year. And obviously some of this relates to COVID, but they made some decisions, non-Social Security and Medicare spending during past legislation during the COVID that doesn't just affect the trying to get out of COVID this year. It has long-term effects, which Chuck will talk more about. We calculate if you add Social Security and Medicare to the government's numbers, which again, the government doesn't believe Social Security and Medicare are a liability of the federal government. We do. So we calculate the government's debt burden at $123 trillion. That amounts to $796 trillion per taxpayer. The unfunded Social Security now totals $41 trillion. Medicare is even higher than that. I think it's immoral for what the people in Washington to make these promises to our seniors who are counting on them, but they have not funded them. So I don't know how much seniors can really count on those. In addition to seniors caring about this, many Defense Department officials have said this is a national security issue. We don't have the economic might that we used to, so we may need to use our military might to get our way around the world. This debt actually makes our wealthier Americans more wealthy because they hold a lot of treasury bonds, and those bonds are held by wealthy people, Wall Street, and they get interest on those bonds. So I will end my comments, and we look forward to your questions, and I'll turn it over to Chuck. Thank you very much for attending today, and I apologize. I have a little bit of a head cold, so I'll try not to cough during this session.
Thank you, Sheila. Before I talk about the content of the financial report of the United States, I want to talk about the timing. The government usually gives itself 180 days to issue its financial records. Realize corporations only get 75 days after year end to have all their financial records issued. So at least the federal government issue was timely. However, if you get the report by the end of March each year, think about that. The President of the United States gives his State of the Union usually a month or two before the finance report comes out. Now imagine if a CEO of a company wrote its shareholders letter and said, well, I can't really cover the finances because they're going to come out in 30 days. Why in the world does the Treasury Department issue the financial statement at the end of their fiscal year, which is 9/30 each year, September 30th, when in fact they have 3-4 months to put this together in time for what is usually the timing of the State of the Union? And I think every president ought to be speaking to the financial condition of the United States. However, if you look through all the speeches, it's almost never mentioned. So with that, I'll get into the content and realize this is a 256-page report, and I'm going to share what I think are the 4 most important pages, so you don't have to read all 256 as I did. So Courtney, if you can pull up page 14 for me. So hopefully it'll appear on the screen, and we can make it a little smaller so we can get. So this is the first table. There we go. That's good size. And at the top, we have the financial measures in billions. And it's important to understand, because you look halfway down or at the bottom of the page as it shows here, there's also sustainability measures, which are dollars in trillions. So basically at the top, you've got a current year look of the United States government. And at the bottom, you have a 75-year look as to what's going to happen in the future in the Treasury's opinion. So at the top, in the income statement, you see the $3.13 trillion deficit for 2020. This was up 218% in 1 year versus last year's 984 billion. So we all knew we had a bad year in 2020. No surprise there. And the $3.1 trillion was well published by the media, and every story you read about the finances focuses on this number, 3.1 trillion. You go down to the middle of the page, you can see in federal debt, we have $21 trillion of federal debt now outstanding under liabilities. And that was up 4.2 trillion in a single year. So how did we finance our $3.1 trillion deficit? We borrowed $4.2 trillion. So we actually have, the government has more cash on hand than it had before the deficit. So our net position on liabilities is 26.796 trillion at the end of 2020, and this is a degradation or decline of 3.8 trillion versus last year. Now, Janet Yellen in the Treasury report tells us that the debt to GDP is now 100% versus, and they draw the contrast, when it reached a high of 106% in 1946, right after World War II, because the government had done so much borrowing to finance the war. So our government position on debt to GDP is similar to when we ended World War II. So now we get down to what I think is the more important part of this page, the 75-year look, the sustainability measures in trillions, not in billions. So here, the Treasury is kind enough to show us that they think Social Security is 19.7 trillion short over the next 75 years. Medicare parts A, B, and D are 45.7 trillion short. And you can see both of those increased by trillions over last year. But the number that really gets me is you go down to total federal non-interest net expenditures, and over to the right, that 30.5 trillion. To me, this is the most important number on this page. This is the Treasury Department of the United States federal government telling its citizens that in 1 year's time, the federal financial position declined by 30.5 trillion in a year, including the current year deficit and all future year assumptions, next 75 years payouts. That is so much larger a number, and it's difficult to understand because you have to make assumptions about what's going to happen the next 75 years. And I'm here to tell you, I have never seen this number appear anywhere on any media report. You see the 3.1 trillion all the time deficit current year. You don't see how dramatically the federal government self-reports the decline in its long-term financial position. They also highlight that in the next 75 years, it is forecasted that our debt to GDP ratio will rise to 623% from the current 100%. What's nice of them to tell us that, it's shocking to think that it would ever get that far, that people would, why in the world would you even buy treasuries if you had a debt to GDP of 623%? So next I go to the next page and say, tell me more about this $30.5 trillion. And you can see it there in the middle of the page under change, 2020 versus 2019 at the bottom there, change, go down, there you go, circle that one. There's that same $30.5 trillion. So how did we get there? Well, the good news is the assumed receipts by the federal government for the next 75 years are up $5.6 trillion. We're going to get 5.6 trillion more from our taxpayers. 2.7 trillion coming from individual income taxes, 1.7 trillion from corporations, and 2.9 trillion more from Social Security. Those are increases in 1 year's time assumed by the federal government. This is them saying, great news, we're going to collect a lot more taxes from you, 5.6 trillion more. The bad news, the really horrible news, is you go down to the total non-interest spending and you see 36.1. So we're going to collect 5.6 trillion more over the next 75 years, but the government is going to spend 36.1 trillion more. And this is a 1 year change. They thought last year they were going to spend 338.9 trillion. And 1 year later, they think, well, we'll more likely spend 374 trillion, up 36 trillion in spending in 1 year, assumed over the future. So where does all this spending go? Well, you can see it detailed there. 6.5 trillion more to Social Security, 4.5 trillion more to Medicare Parts A and B, 5.5 trillion more from defense spending, 5.9 trillion more non-defense discretionary spending. And then the one that really frosts me is other mandatory. So circle that 13.1. And there you see the government telling us in 1 year time, we've assumed we're going to spend 13.1 trillion more on other. This is not even one of the primary categories. Now, if I were doing a financial report and I had a $13 trillion change in 1 year's time, I would certainly detail it. I think what's in here are a lot of federal employment benefits for federal employees, VA benefits, unemployment, food stamps, housing subsidies, all the programs that were initiated, inclusive of those, for pandemic and COVID handling and response. But it all gets lumped into other spending, $13 trillion, barely detailed here in this exhibit. I should say it's very much detailed in the current year of 2020, how much we're going to spend in all the pandemic response. That is greatly detailed. And I should congratulate the Treasury for being so open and transparent on the current year. The part of the transparency that's missing is the future year mandatory obligations that they've signed us up for that aren't fully detailed in this $13 trillion change over 1 year. So again, the government thinks next 75 years, federal government's going to spend nearly $375 trillion. Oh, and by the way, that 5.4 fiscal gap, you see a percentage there? That is what's included in the executive summary. They don't talk, the government doesn't talk about, hey, our position deteriorated 30.5 trillion in 1 year. They talk about our percent of GDP that we're short is 5.4%. And it, in the executive summary, 5.4% doesn't get anyone very excited, and that's not cause for alarm. It's only 5.4%. Well, to make up that 5.4%, each year for the next 75 years, to balance at the end of 75 years, the government would need to raise all taxes by 30% or cut all spending by 24%, or some combination of the two. In other words, massive change. So can it get any worse? Yes, it can. Page 202. So here we have, remember on the last chart, we had the long-term look. It had a 75-year time horizon. Here, the federal government says, well, now we're going to look at an infinite horizon. And the reason that that's important is because when you look at 75 years and you truncate at the end of 75 years, think about this. You've included all the Social Security and Medicare pay-in for the next 2 generations, but you've excluded the payout to Social Security and Medicare for the same next 2 generations when you truncate your look at the end of 75 years. So if you don't do that, you say, okay, let's go beyond 75 years because these people we've been collecting Social Security and Medicare payments from for 75 years, we're going to owe them benefits. Well, if you take the infinite horizon view, lower right-hand corner, it's 153.7 trillion. And this, I want to point out at the top of the page, is as of January 1st, 2020. That is pre-COVID and pre all the new programs. So we saw in the earlier exhibit how we're 30.5 trillion worse in 1 year's time. And here the government is saying, yeah, we think we're really 153.7 trillion short over an infinite horizon. And you can see what parts of the entitlement programs are causing the problem. Part B is we're short 79.6 trillion. That's the medical part of Medicare. Part D is the drug program, the new prescription drug. We're 26 trillion short. Realize the prescription drug program came in with George Bush. That wasn't that long ago, and we're already 26 trillion short in the obligations for that. OASDI is old age survivors disability insurance. That's really Social Security, and that's 55.9 trillion short. Now here's a number I will confess I do not understand. If you go to the left-hand column, that HI, that's hospital insurance. And over the infinite horizon, we actually are doing much better in hospital insurance. And I asked myself, how the heck did that happen? Well, because we have a negative $20.9 trillion net obligations for future participants. Oh, so when the hospital program trust fund goes bust, as it's projected to in 2026, we will come out with a new tax, if you will, and collect an extra 20.9 trillion from the citizens to cover hospital insurance. And that will afford us a better outlook over the infinite horizon. So there's a lot of really mysterious things in here, and these are big numbers. Now, these numbers going out 75 years or infinitely are only as good as your assumptions. So let's look at the last of my 4 pages. And this is the assumption page. So this is, you can see, starts in 2020, goes out every 10 years, all the way to 2090. So this is the government assumptions for the next 70 years. And we see that fertility, which came down during COVID, is going to rebound, and we're going to have a fertile and prosperous citizenry. It's going to stay level at 2.0 children for each person over time. Then you can see the death rate, and good news, our death rate is going to go way down because we're going to have new medical and technology achievements. So we're going to have only 460 deaths per 100,000 in 2090 compared to 790 deaths. And guess what? We're going to solve our immigration problem. Our immigration is going to be a smooth 1.4 million people per year, going down to 1.2 million. But we're going to have no immigration influx over the next 70 years. It's going to be smooth sailing, 1.4 to 1.2 million new citizens per year through immigration. I'm sorry, in thousands. Now here comes an assumption that I just don't get. We get to the life expectancy, and great news, the males who now are supposed to, on average, live to 76.4 years are going to live to 83.3 years of age in 2090. The females are going to do even better, 81 to 86.9. So that on average is a 6.9 year increase for males and a 5.6 year increase for females. Well, that's terrific over 70 years. And I asked myself, well, is that reasonable? So one way to check that is to say, well, what's happened over the last 70 years? So I went back to 1950, and I found that the average age of males in 1950 was 65.6. and rising to the 76.4 in the last 70 years, males' life expectancies increased 10.8 years. Females went from 71.1 in 1950 up to 81.3 in 2020. So they increased 10.2 years. So the government's asking me to believe that over the last 70 years, the life expectancy increased 10 years on average for males and females, but it's now only going to average an increase of 6 years over the next 70 years, despite all the technology we have. And I just don't buy that. I think life expectancy 70 years from now is not going to go up an average of 6 years. It will be more likely 20 years. And if you roll that into assumptions of everyone living 20 years longer instead of 6 years longer over the next 70 years, it blows up all the numbers, and our economic fiscal position is much worse. Now, if you go down to the other assumptions, those seem pretty reasonable to me. The CPI inflation, 2.3 now, is going to run 2.4 for the next 70 years, very consistently. If I were a betting person, I would bet there'd be a big spike in inflation somewhere along the line of those 70 years. Our GDP is going to grow steadily, 2.1, 2, 1.9, 2, 2, 1.9, 2. We're going to have very smooth GDP with no recessions. Now, I don't want to be too critical of the government. It's very hard to forecast when there will be recessions. But over the next 70 years, we're going to have some big ones. And it's not going to be a smooth 2% going out over 70 years. Now, here's an interesting one. Go to average annual interest rate. So the average annual interest rate on government debt, 2.3%, is forecasted to rise to 4.7 and then stay there in 10 years' time, rise to 4.7 and then stay there for 60 years. That's what's assumed. Well, I asked myself, what happens to the stock market and the economy if interest rates go from 2.3% to 4.7? A big part of the answer is how fast that happens. This assumption presumes it happens over 10 years. If it's very smooth and gradual, it's like cooking a toad in boiling water. You hardly notice. If it were to happen quickly, it would have a dramatic effect on both the stock market and the economic growth. It would be significantly harmed if it went up at all quickly. But I don't think it's so unreasonable, given where we are today, to think that we're going to have 4.7% interest on an average basis over the next 70 years compared to where we're starting today. What concerns me is how we get to it. So then we get into per beneficiary costs for hospital insurance, medical, and drugs. And I didn't think these assumptions were too unreasonable. And I thought there's going to be a lot of legislative change that can hold these down, hopefully. You can see medical costs right now running at 6.5% increase per year. And by 2030, it's forecasted to rise 8.3% per year, but then fall down dramatically. So perhaps our technology gets so good that people stop getting sick. So those are my assumptions. And those are the 4 pages I reviewed. Hope you found it interesting. And we'll take questions.
Well, thank you very much, Chuck and Sheila. To set the stage, granted, those other mandatory spending numbers were very large. Let's put that aside for the moment and talk a little bit more about the social insurance programs. Sheila, could you talk a little bit about why our numbers for truth in accounting for the federal debt are so much higher than the reported national debt, and what their assumptions are for why they choose to exclude the unfunded Social Security and Medicare from the balance sheet?
Yeah, thanks, Bill. Yeah, I'm amazed. As an accountant, you record a liability if you can estimate it, and we know the amount of unfunded liability for Social Security and Medicare, and if it's probable that you're going to pay it. I would assume that most Americans believe that they're going to get some form of Social Security and Medicare. But on the federal government's balance sheet, they record no Social Security or Medicare liability. And the reason that they don't is because they believe that they can change the law at any point in time. And again, in accounting, if once, if you would book the liability, and then when those changes happened, you would increase or decrease the liability. But the federal government says that they don't owe anybody any Medicare or Social Security liabilities. When I testified before the Federal Accounting Standards Advisory Board on this matter, I said, well, if you're not going to record it as a liability, I really believe you need a massive education campaign to let the American people know that they are not owed any Social Security and Medicare liability. The other point that they were making in this discussion was that the amount that the taxes that you pay in for Social Security and Medicare have nothing to do with the amount of benefits that you get. Those are not linked, and you are not guaranteed to get any benefits based upon that you have contributed. It's not a contribution, it's a pure and simple tax.
Well, that's a little bit interesting in part because the federal government, when it put up a new web page for the Social Security Administration, and they had the page for your Social Security, you could look up your account. They had a message on the front of that web page, rest easy, take control of your future, open a My Social Security account today. So here's our government telling people to take control of their future by signing up for their account at the same time that they don't record a liability, because the government controls the law at any time and can change it at any time. That was
and I found it interesting. We've done studies looking at congressional websites, and many of them have that these are guaranteed benefits. But again, the federal government does not book them as a liability.
In light of the assumptions that Chuck was in his last page looking over and thinking about, here's another question for Sheila. Could you explain what an audit is, and in turn, what is the audit of the federal government's financial statements? What is the opinion delivered by the GAO on that statement every year, and how does that relate to these assumptions?
So I was telling Chuck and Bill earlier, I really believe that the financial report of the federal government should be mandatory reading for all, at least accounting students and finance students, especially in light of the opinion that they get. So what happens is, in business and in the federal government and state and local governments, CPA firms come in and they audit them. They look at their transaction, make sure things are reported properly. And they give them a grade, in essence, and a clean opinion is what most companies get. If you don't get a clean opinion, there are financial consequences to that. But the federal government gets what they call a disclaimer opinion, and that is they flunk their audit. And the Government Accountability Office is in charge of the audit, but outside CPA firms do that audit. And I always find it amazing that the largest contributor to this disclaimer opinion is the Defense Department. And so again, the Defense Department, they cannot figure out where they spend their money, and they can't figure out the assets that they have. If a defense contractor received a disclaimer audit opinion, they would probably be no longer a defense contractor, but the Defense Department can get this disclaimer opinion. They can flunk their audit.
Okay, for Chuck, I have a question. Chuck, your insurance industry experience is, I think, very valuable for considering the United States government. In light of those massive, theoretically unfunded obligations at the Social Security and Medicare and other programs, my question for you is, could you talk a little bit about how insurance companies establish reserves, and in turn, any thoughts about, why is the federal government of the United States different, and how?
Well, if insurance companies do a poor job of setting reserves, the company goes bankrupt, or people sell all the stock. You can see it pretty readily in the annual financial reports. Setting reserves for insurers is pretty easy for the property casualty lines of auto and home, which are a very large portion of the insurance industry. It's more difficult for long tail lines like workers' comp, or professional liability or environmental liabilities. Those are very hard to set. In the life and health business, it's generally easy to set life reserves, but it's hard to set health reserves because it's hard to predict the inflation rate of medical care costs. And then there's a whole separate segment of reinsurance where it's hard to set on certain layers. But the one thing I would say government could learn from private industry is the reserve triangles. And insurance companies are required in their 10K to list a reserve triangle showing each year the reserve estimates by line, and it creates a triangle so you can see where the reserve was estimated for that year 10 years ago, 9 years ago, 8 years ago, 7, 6, 5, 4, 3, 2, 1. So you can see the development over time for each year by line. Well, that when you just look at that triangle, you quickly see, hey, is this management or this company been honest in setting its reserves? I shouldn't say honest. Have they been accurate in setting their reserves? Yes or no? And it's pretty easy to tell. If the government would give us a 10-year look of their estimates, we have all their estimates each year. We'll put them in a table showing us how they've changed over time and show us the actuals next to the estimates. That would be a very clear, easy thing to do, which would be very illuminating.
That could be something we propose to the Congress or the FASAB or both. That sounds like a good idea.
Yeah, I find it interesting that, especially during the housing market crisis where the government, in essence, gave money to the banks. This current crisis, we're handling people's unemployment, just where we've become this, in essence, a big insurance company. If something goes wrong, the elected officials and the citizens seem to lean on the federal government, which would be fine if they had reserves set aside to fund those. But instead, we borrow, and we borrowed more than half of the budget last year during this crisis. And if we didn't, when are we ever going to reach our borrowing capacity? That would be the question. Is at some point in time, are we going to get to the point where we can't borrow anymore? People won't lend us any more money. And then when we have a crisis, since our model is to borrow the money, we would not be able to help people out when they need it the most.
Along those lines, if and when a crisis arrives, my next question for both of you is, whether or not the widespread assumption that U.S. Treasuries are a good proxy for risk-free interest rates. Chuck showed that nice smooth line of 4.7 flying out to 2080 or so. Is it possible that in light of the uncertainties we've talked about, that maybe the assumption that Treasuries are a good proxy for risk-free interest rates, is that something worth?
Well, it's certainly not a market rate. The federal government, the Fed is buying $120 billion of bonds each month. And that is distorting the auction of what should be the correct price at which these issuances get settled at. And for the time being, the Fed can absolutely set it pretty much to wherever they want to set it. Quite frankly, I've often thought, well, if the Fed has that much power, why don't they just set the rates at negative rates like it is in Europe? And we can take care of part of our financial crisis by having negative interest rates, except that causes a whole other set of problems. But it would solve the fiscal problem if the government got paid by all the bondholders, but no one would own bonds anymore. But right now, it's not a representative rate based on the government being the largest bidder.
Is it possible that inflation risk is part of that signal that's not necessarily being identified in current market interest rates? If they're not market interest rates?
I have a comment on inflation. I don't trust the government's measure of inflation. First, you have to ask yourself, what is the incentive for the government to be accurate on inflation? Well, The higher inflation is, the more Social Security costs get indexed and therefore more entitlement costs. The higher inflation means tax brackets get adjusted upward and lower receipts. The higher inflation, government debt and interest costs go up, and we've seen how much the government's going to owe. So they don't want government inflation to go up too high. And then you take the specific examples. Housing. Housing is 42% of the CPI, and it's judged based on a monthly equivalent rent survey. They're asking people, if you were to rent out your home, how much would you charge for rent? So over the last year, for example, the CPI says home costs went up 2%. Well, Case-Shiller has a housing index, and over the last year, their housing index went up 10.4%, a lot more than the 2%. Then you take something like healthcare. Healthcare is 18% of the CPI index. And healthcare costs exclude medical costs paid through employers and Medicare Part A. I have no idea why they exclude those, but PwC measures medical costs as up 6% per year over the last 6 years versus CPI medical increases of 2.8%. So PwC independently says medical inflation's been more than double the reported inflation. And lastly, take vehicles. The government uses what's called a hedonic quality adjustment to change how they view price changes in vehicles. So according to the government, over the last 30 years, new vehicles have gone up 22.5%. But the price of the number one selling car, Camry, is up 68% over that time. And the price of the number one selling truck, a Ford 150 pickup, is up 170% over those 30 years. So the prices go up massively more, but the government says, yeah, but you're getting a higher quality product. Therefore, the higher quality, you're getting a better product for it. So we're going to adjust the inflation down to, in this case, 1/5 of the actual price increase.
While we're raising issues, accounting for inflation and who does it and how well, certainly is in our neck of the woods at Truth in Accounting. There's much to discuss, but I right now like to go to some audience questions that are related to these inflation questions. The first one is, what does the end scenario look like? And then a very articulate questioner states, what is the 2025 version of wheelbarrows full of Deutschmarks? I feel resigned that there are no good solutions to the overwhelming debt debacle. It's too big to tax our way out of, and it's too big to pay off over time. The US and EU cannot default our way out, which would lead to global financial collapse. The only solution seems to shrink the debt via the inflation beast. Are there any other solutions?
Well, I think we will pay our way out. We will print money and pay every penny due. And what will save us is the fact that Europe, England, China will also print money and pay every penny due. So it's a relative thing in the world. But over time, over long periods, I think real things, commodities are going to be worth more, and the dollar will be worth less because there are so many more dollars coming our way.
So is that good for us, or is it good for the government, or both, that we can pay our way out through inflation?
Well, it is unique in world history that the largest debtor nation in the world also has the strongest military in the world. Because think about that. How do you get to have the largest military in the world if you owe so much money? Well, we've arrived at that position, and I think we're going to hold a strong position no matter how much we print relative to the rest of the world.
Well, won't we be in trouble because as you were mentioning, the healthcare is also tied to inflation. So as the inflation goes up, the healthcare and Social Security benefits and all of that will also go up. So I don't see a way of growing ourselves out of this, because unless they, stop indexing, well, they can't stop indexing Medicare medical costs to inflation because those go up higher than inflation. They could stop indexing, Social Security to that, but Medicare medical costs, as inflation goes up, those are going to get even more expensive, and the federal government seems to be putting itself on the hook to pay for those.
I think it's worthy to question, in light of the title for today's session, an unsustainable fiscal path. Perhaps the way out that's been, possibly identified is not sustainable itself. It's an unsustainable monetary path. Can that solution actually happen without significant difficulties down the road? A related question comes from a former Federal Reserve economist. Although the Fed is independent, it is still a government entity. Why not net out Fed holdings and add the monetary liabilities, i.e. Federal Reserve notes? It seems appropriate if you're counting up unfunded liabilities to merge the Federal Reserve with the United States government's balance sheet, both what it reports and what is reality, whatever that means. Any ideas? It's a hard question.
The thing that's difficult about consolidating is the Fed is not funded by taxation. The federal government is funded by taxation. The Fed is funded by printing money. I'm sure there's a more technical answer to that, dealing with bank reserve levels going up and down. But essentially, I simplify it to it prints money, and that's how it funds itself. So combining an entity that funds itself by printing money with an entity that funds itself by raising revenues by taxation, it complicates things in combining those two entities financially, in my opinion.
We have a friend of our organization that believes that the statement and account clause of the U.S. Constitution calls for all public money to be on the statement and account. Let's put aside for the moment whether or not we've had a good statement and account according to the Constitution. But looking back in history and today, the question arrives, should the Federal Reserve be consolidated as a matter of constitutional law?
I'll leave that to other constitutional experts. We have enough problems in the finances as they exist today without debating the consolidation of the Fed within the federal U.S. government balance sheet.
Okay, let's get to a little less heavy topics. We have a good question regarding the other mandatory spending.
Yeah.
Is that one question that he had was, does that include interest on the debt?
No, it does not, because it's in a table that's labeled non-interest spending.
Okay, good point. Here's a management question for you, Chuck. As you digest these numbers, how would you bring this data to light if you were a financial advisor with your clients? This data is great, but how do you make it actionable?
Well, there's two constituencies. One is clients who I think of maybe as investors, where I try to point out that real things are more important than paper money. The other constituency is the government, how to bring it to light to the government, and more importantly, to the media. This issue doesn't exist because the media doesn't cover it. It's not, we see the deficit each year published in articles on that. We don't see any discussion of the long term because it's complicated. And quite honestly, when I talk to people about it, I get two reactions. One is, I don't want to hear about it because it's bad news, and I have enough bad news in my life. I don't want to hear any more bad news. That's a human reaction. The other reaction is, I don't want to hear about it because I can't do anything about it. And we've seen this coming so there's a sense of hopelessness. And politicians will never take it up, because if you take it up, you'll never get elected. So
Are you hopeless yourself, Chuck? That relates to another guest question. Is there a way you can get this message, A, to the political class and the public, and B, acted upon?
I think you have to go through education, and I would make mandatory study of the finances of state, local, and federal governments. It would be one level of detail at the high school level. It would be a mandatory credit, if you will, to get a college degree. There are so many new citizens that will be voting that have no idea of this, and they need to be educated.
Go ahead, Chuck.
No, I'm done.
Yeah, the other thing is, Chuck, you pointed out the future revenue streams and expenses, went down by $30 trillion. I think $19 trillion of that was in relation to, decisions that the Congress made during the pandemic, as they were, offering additional benefits to get through that. When they made those decisions, did anybody sort of go, well, hold it, guys, just so members of Congress, when you were debating those and deciding whether they should, in essence, put the government on the hook for paying these benefits over time, did anybody mention to them that, hold it, you're just added, $30 trillion, $19 trillion to, our cash flow got worse. I don't think members of Congress know that when they're debating these things.
That's actually relates to another question directly from Tom Carlton. Here's his question in the words that he said. Does budgetary law set the requirement for the 75-year and infinite horizon projections or not? The numbers are astounding at such long times.
I don't think there is a 75-year mandatory statement. They mirror what Social Security and Medicare use, and Social Security and Medicare use a 75-year look. So that's why the government mirrors that look.
Sheila, you're muted.
But do they look at that while they're making decisions? Our members are, I think one problem we've gotten into is members of Congress, especially the House members, have very short-sighted views, and they're making long-term decisions, and they don't know they're not told the financial consequences of those decisions, because I think they calculate 10 years out, but they don't look 75 years out. They don't look infinity when these long-term decisions are made.
And in turn, we have, for instance, the reported budget deficit, as Chuck reported. We also have the net operating cost. But should we be thinking about budgeting, Chuck, on the other set of numbers that you identify, which are so much bigger than that?
Well, and again, nobody seems to care that, except for Chuck and us, that we added $30 trillion, or the net position went down by $30 trillion. That's.
If we truly balance the budget, should we make up 30 trillion in 1 year? How do you?
Well,
it's
should
too
they
large
be making
to be possibly made up?
Should they be making those decisions?
Go ahead.
That would be another issue.
There are many other interesting things in this 256-page report. Most of them I skip over because they're dealing with billions and hundreds of billions. And truthfully, it's only the things that deal with trillions that matter to what the ultimate outcome is. But one of the billions thing was interesting. You come to the IRS and they estimated, based on a study from 2011 to 2013, that $441 billion a year, based on those years, went uncollected, money that was due and not paid. And then last week, the IRS new director just came out and said, well, it's now likely about $1 trillion. So it was interesting that government got so big, and yet we have 17,000 fewer employees in the IRS than we did a decade ago. And we could collect probably $500 million a year more, but that still doesn't get you to solving a $30 trillion deficit each year, all inclusive.
Another small number that drives me crazy is they call it the unmatched transactions and balances, where they couldn't get the balance sheet and income statement to total correctly, so they plugged it by $11.6 billion, and that's actually a swing. It's $50 billion off this way, and $75 billion. It nets to $11.6 billion. But again, as Chuck said, that's small numbers.
Well, to finish up, I've got some related end of the world scenario type questions. I think and one of them is a little bit longer, but it's a good way to consider what the end scenario might or might not look like. And here's the question, actually several. Given the historical bad behavior, why we haven't blown up already? Why haven't we blown up already? And since that hasn't happened so far, what will cause it in the future? Is it possible that it hasn't happened already and therefore it won't happen in the future? It's hard to believe that behavior will be worse than it is currently. And if we do blow up, go ahead.
You have to think of it in a relative basis versus an absolute basis. So Japan today is the country with the worst debt to GDP at around 270, and if we're at 100, so you kind of watch Japan as the canary in the coal mine, except they have a whole different saving structure than we do. But as long as all governments borrow excessively simultaneously, it's very hard to imagine that one country gets singled out and blows up. And I saw one other question in the chat box. They asked what pages were those that I referenced from the report. These are pages 14, 66, 149, and 202.
Yeah, and I think that as far as back to the question, I think that we're the best of the worst. So people are still willing to lend us money because the U.S., even though we're in bad shape, we seem other countries are in worse shape. So we're the best of the worst, and so we're safer than other countries. So people are still willing to lend us money, but I get nervous because I heard, I talked to accountants who were trying to, help Venezuela and an Eastern European country. And when they were starting to go through financial crisis, and they said, these accountants said, yes, there were a few people mentioning it then, but then overnight, things just became a disaster. And that's what makes me nervous. And the housing market crisis, even made me more nervous because, again, everything seemed to be going along. And then all of a sudden, bang, we hit a huge crisis. And will this go along? Will we have a soft landing and be able to, cut services and benefits? Or are we going to have a very hard landing like they've done in other countries?
In light of the release of the report, the financial report of the U.S. government, and the lack of any real public communication about it or discussion, including media discussion, how can you square that absence of information with the widespread and loud communication about the budget of the United States government? Is there a reason why we care more about budgets than we do accounting for financial performance?
I think it's simplicity. It's easier to understand a 1 year what just happened versus a very long-term, lots of assumption-driven financial outlook.
And also those are, the budget is the decision-making process. So people care about how money is going to be spent and how, but then again, they don't look at, people unfortunately are very, short-term focused, especially elected officials, and they don't look at the long-term consequences of the financial decisions they're making now.
All right. Well, yeah, I think it's a little sad.
I want to point out that there's no reward to a citizen, a media, or a government official detailing how bad the news is. think of what is the reward for being complete and detailed. It's such bad news. Nobody wants to, you get no reward for being the bearer of bad news.
Hopefully,
And that's why we have truth in accounting. And, that's why we're trying to, highlight this to people. Because, even though it's not news people want to hear, it's news that people need to hear.
people care more about spending money than accounting for it. And hopefully we can inspire better behavior in the future. Chuck, thank you very much for being here and for your interest in what we do and your contribution to helping people understand things today.
My pleasure.
Okay.